Hello, and welcome to Instant Insights, Global Data's strategic intelligence podcast. At Global Data Strategic Intelligence, we track over 100 tech, industry, ESG, and macro themes impacting all major sectors. I'm Stu Robarts, and in today's episode, we're discussing the decline of the London Stock Exchange. It was announced this week that UK semiconductor company Alphawave has been acquired by Qualcomm, marking another high-profile departure from the LSE. Although it remains a major exchange, fewer IPOs, lower valuations, and diminished global status mean the LSE is not the force it once was, and reviving it will be a challenge. My guest today is Carrie Osman, founder and CEO of growth intelligence consultancy Cruxy. Cruxy advises high-growth fintechs and enterprise tech scale-ups on positioning, expansion, and market strategy, giving Carrie a ringside view of the LSE's travails. Carrie, thanks for joining us. To begin with, what's your view of the current health of the LSE?
Well, I think that kind of states in the numbers, there's a lot of firms that are kind of delisting. I think we've seen that with kind of Alphawave and Qualcomm. Obviously, it's not a particularly attractive place in which to list. I think you see that where you see kind of these Israeli tech companies going and listing in the US. So we see it kind of across the board that I think it's just not, it doesn't have the liquidity, it doesn't have the buoyancy, and it doesn't quite frankly attract the most innovative technologies to list in London because of the fact that there doesn't seem to be the appetite from an investment pool to kind of provide the liquidity that obviously some of these founders or private equity firms are looking for.
And so what are the factors that you see as the kind of main drivers behind companies turning away from the LSE?
So I think some are structural, but the main one from my perspective is definitely liquidity. I mean, ultimately, you're looking for people to back your concept or idea, and you're looking for them to believe in that with their, money, ultimately, to kind of buy shares in your company and say, yes, I believe that you're going to make me a lot of money. Let's go long here. I was looking at some facts and I thought it was very interesting that, for example, in the UK, about 23% of adults have stocks and shares. When we compare that to the US, it's 62%. Now, I understand that obviously that's driven by the 401k, which is the ability to put your pensions into that. But I think nonetheless, the numbers speak for themselves. I'm a big kind of, hopefully very caring, but definitely a capitalist. So I think that ultimately, why do you want to list? You want to list because of that kind of ring the bell moment and the fact that the market recognizes your hard work and grind by increasing the value through supply and demand of your share price. And if that isn't going to be something that you can do because there isn't the liquidity sitting one side, then I think that's always going to be a very much a challenge for the LSE.
The problem seems to have been exacerbated since the B word, since Brexit. Is that something you'd kind of agree with, and is it something you see with your clients or not so much?
I don't know. I think people have always been, we work in tech and we service, tech firms and their investors in private equity. And I think there's always been a lot of buoyancy, in the US for that. And there's always been a bit more of an appetite. Personally, always seen a kind of very commercial, I'm sure you're smiling, so I'm sure you have as well, this commercial appetite for doing business, come and sell to me. Let's do great business. Let's make money together. And I think that I don't know whether that's been worsened by Brexit or not. I think obviously Brexit does create a lot of different complexities in the UK that probably when we were part of Europe, you could argue were not as risk, they didn't feel as much of a risk for people to take. But when you look at just Europe as a whole, I think 183 European listings and only about 15% of those listed in their home turf. So I think it probably is kind of far and wide when you look at Europe as a whole. But of course, there's always more devil in the detail. I'm sure someone's dug into all of the detail, but it definitely doesn't seem that it's quite just the B word, dare I say it.
And from your perspective on the tech side of things, what is it that seems to be making tech companies particularly reluctant to stay or to list initially on the LSE, do you think? Is it purely that kind of liquidity thing, or are there other factors at play?
I think there are some other factors. I mean, just purely at a macroeconomic level, the price of debt is obviously so high. And a lot of people, when they list, it seems from the data I've looked at, seem to do a lot of M&A. And if that M&A is going to require debt financing, which often it does, obviously we're just in a very turbulent time where the price of that debt is just so high that it kind of stagnates a lot of companies. I think from my perspective, just personally, the other thing that we see a lot of is almost FOMO investing, where people are very much, just jumping on the next bandwagon. They're not really thinking through, they're not doing that level of deep due diligence. And I guess you can see that almost leading to things being hugely either over or underpriced. The market isn't a specialized market. It doesn't seem that people seem to do that level of diligence that one would expect, or that one might see in some of the very specialized private equity firms. So I think you see, it's a lot of different competing things at play. And dare I say, there's no silver bullet, which is obviously very frustrating, I'm sure, for the LSE. I'm sure they've been hunting for one. But it definitely seems a lot more nuanced. And of course, you've got private equity who are looking at doing public to private deals. They're all, they've got dry powder and they're looking at kind of, right, what can I take from the public exchanges and kind of rework, and maybe list again, or maybe do M&A with that and kind of create a lot of increase that asset value significantly behind closed doors. So I think it's definitely a number of different competing factors.
You mentioned there that there will be levers that the LSE will be looking to pull to improve its attractiveness, if you like. And is there anything that comes to mind for you that the LSE and perhaps the UK more broadly might be able to do to kind of stem the flow and turn the tide a little?
Yeah, I think there's something that they're trying to launch called the Pisces framework, which is trying to enable secondary. So if I own shares in, a company, I can trade those shares without listing it publicly, so that there'll be these kind of trading windows, so I can trade those shares and, an asset manager can buy them all. But it's only, the thing that concerns me about that is that it's only secondaries, so it's only certain people they decide can do that, who are professional investors, whatever that means. And it obviously, who decides the price? Is this just regulation? All the positive consequences, but it ends up with a lot of, regulation on regulation, and it ends up with a lot of complexity. And I'm worried that that could end up being, a lot of positive intent, but maybe it doesn't lead to that outcome of driving liquidity that they would hope. I personally think that there's a lot that you could do with, if you look at what the US have done with the 401k, how do we encourage everyone from, quite frankly, children to get more astute with the markets? How could we encourage people, of course, in a risk, not saying that we're saying, let's give all kids a load of shares. That's not what I'm saying. But how could you encourage people to kind of play an active role in the market? Maybe, teach them about the market, teach them about stocks, teach them about trading. And then, of course, maybe there's ways that we could use tax incentives to encourage either companies or, of course, employees to be able to kind of feel like they can, invest in the markets without feeling like it's so much of a risk. It always feels like it's kind of less of a risk to just stick your money in an ISA and fingers crossed, the Bank of England don't, reduce the rate too much. Whereas I think that was how I was brought up. And I think it would be amazing to think that there's a way to encourage a more, slightly risk taking, but with a bit of a support layer there, so that people feel they can invest in our country and invest in some of our great assets.
Just flipping it on its head slightly, in your capacity as a growth consultancy, what advice do you give your clients who might be considering where to list?
We would probably think more about the market and the kind of buoyancy and the way that the market's structured. So generally in the US, there's a lot more investors who kind of conceptually understand AI. There's obviously a lot more of the AI, large language models, Anthropic, for example, that have been of OpenAI that have been created in the US. So if you're reliant upon people really conceptually understanding, that type of business and that type of market, then I think the US is quite interesting. I think the US is also just generally quite a high consumer of technology. So if you're looking for like high consumption, if I was Slack or someone like that, I'd probably say there's probably more people that side of the pond that would really understand it. I think this side, we've got some great examples with infrastructure plays. Obviously, Germany has a great infrastructure. We, in the UK have an amazing services and banking sector. We also obviously have a lot of buy side firms, asset managers, hedge funds, etc. So if I was playing into kind of capital markets, in that sense of, selling into hedge funds and asset managers, I might say, well, actually, you've got a real foothold in London that can anchor you to Hong Kong, Singapore, Zurich, and then, of course, to New York. So I think it really depends on the market that you're serving. And of course, that ultimately, generally, my theme would be that gives you more of an astute specialist audience who really understand what they're thinking and what they're talking about. And they probably, therefore, one would hope, would price the value more effectively.
And just finally for me, really, is there anything from your kind of position in the tech sector that gives you an insight, I guess, into this, and perhaps another way that others might not?
Yeah, I think one of the things that we do is we go very, very deep on the product. And I think this is something that many people do not do. So very deep, very granular, and very surgical in terms of what is the product and where is it valued by whom? And do we agree as a collective that that is the right value that the market is kind of ascribing to the product? So I think that can give you a real edge, because if anyone out there is kind of thinking of investing in something, I think there's a lot of people that go very, I call it the ChatGPT level of analysis, which is great. It's a high level, it's kind of macro, but it's the drilling down and asking those 5 whys into the product very, very deep, and what exactly is that feature and who does that mean you can serve, and why does that give you an edge against a competitive set or an incumbent that maybe is very established in the market. And then the second thing is that we do a lot around pricing. And of course, pricing is ultimately, value is in the eye of the beholder, and pricing is the fair price someone is willing to pay for the value of the product. So I think that those are both sides. If we were to think that as a market, we could go deeper on interrogating our product, we weren't just sitting there believing the hype. We were actually drilling 6 layers deeper. You've got examples like Builder AI and Frank, where people just massively stated, quite frankly, their numbers. And no one really kept double clicked and thought, does this actually stack up? Does this, I call it the sniff test, does this pass the sniff test? And then I think the second thing is, and is someone going to pay fair value for that? Am I solving a problem that actually, it's fine if I give it away free, but no one really wants to buy what I'm creating, or it doesn't necessarily solve a fundamental problem. So I think they're 2 things that if the tech sector could really keep drilling into those and keep, of course, I would say that, but I do very passionately believe that it would be for the better good of the market as a whole.
Carrie, that's been absolutely fascinating chatting to you. Thanks so much for taking the time.
Thank you.
Thanks to Carrie for those instant insights, and thanks to you for listening. From us at Global Data Strategic Intelligence, see you next time.